It is my belief that the US government will manufacture a crisis in order to refinance their national debt. So of course, it's going to be highly inflationary. This is going to accelerate the great melt-up, but it must be done. So I'm going to tell you how you can capitalize on the situation. But first, you have to know what's going on. Here is the federal government's national debt over the past 100 years. This is coming straight from the government's website, the US Treasury. So it really started to accelerate in 2008 because of the great financial crisis, the GFC. And then it even got worse during the pandemic. So of course, the government needs to pay interest on the money that they borrow. So here's the average interest rate that the government is paying on their debt. So look at the rates that they were paying before the GFC. Because the government had much less debts, I mean, you saw the chart, they could afford those higher interest rates. Now, when the government borrowed that insane amount of money after the GFC, they could afford that debt because the Federal Reserve dropped interest rates close to zero. Now, when the government added another huge load of debt during the pandemic, they could afford it because the Federal Reserve dropped interest rates back down to 0%. Now, when inflation started to surge, the Fed had to raise their interest rates. So this made the cost of borrowing much more expensive for the US government. So listen, if you have a ton of debt, it's manageable if your interest rates are low. But if your interest rates start shooting up, you're going to be screwed over because, well, just think about it like the people who had adjustable rate mortgages back in the last housing market crash. So in this type of situation with 35 trillion in national debt and rising interest rates, the US government will spend more than $1 trillion on interest expense. $1 trillion. That's more than they spend on national defense, which is around $900 billion. So that's more than Medicare, that's more than healthcare. And the situation is just getting worse because the government continues to overspend and add on more debt. So here's the deficit spending for the past 24 years. This is coming straight from the US Treasury. So look at what's going on. So take a look at this. This is how much the government has been spending annually on interest over the past 14 years. This is unsustainable with higher interest rates. As I said before, this is the reason why the Federal Reserve is cutting interest rates. Just think about it. Just think about it just logically. Look at GDP. Okay, I'm just saying their narrative makes no sense. Look at GDP. GDP is growing at 3.0%. That's the annualized rate. GDP growth 3%, that is amazingly good. Look at the unemployment rate. Unemployment's at 4.1%. That is amazingly low. So according to the government, everything is just fine and dandy. As a matter of fact, this is actually a reason to raise interest rates, not to cut them. Okay, so then why is the Federal Reserve cutting interest rates? It's because the US government cannot afford these higher interest rates. Okay, so here's the situation. The Federal Reserve had their interest rates at 5.5%. That's their Fed funds rate. At their last meeting, they cut rates by 0.5%, which is a huge cut considering how amazing the economy and the labor market is right now. So right now, the Fed funds rate is at 5.0%. Their plan, which is laid out in their SEP, is to bring interest rates down to 3.0% by the end of 2026. And you know what? I call BS because that's not low enough for the government's debt load. So you know what they're most likely going to do? They're going to manufacture a crisis so that the Federal Reserve will have an excuse to cut interest rates back down to close to 0%. And then they're going to take advantage of the opportunity to refinance as much debt as possible at those lower interest rates. So here's how it works. You know how if you want to borrow money to buy a car, that you can get an auto loan for 3 years or 5 years or 7 years. If you want a mortgage, you can get a 15-year loan, you can get a 30-year loan, right? It's the same thing with the government and their debt. They borrow some money with a 1-year loan or less. Some of their loans mature in 2 to 10 years. Some of their loans mature longer than 10 years. Now remember, we're still in a relatively higher interest rate environment right now with the Fed funds rate being at 5.0%. Now, these got issued recently at higher interest rates. As these mature and the government needs to reissue these, they'll be financed at higher rates, again, relatively speaking. The biggest problem is here, the Treasury notes. These represent the largest category of Treasury securities, and they got issued at very low interest rates 2 to 10 years ago. So they have been maturing in 2023 and 2024 at higher interest rates. And you saw the damage with the skyrocketing interest expense. Ultimately, the Federal Reserve needs to cut interest rates quickly. And I'm telling you, stopping at 3.0%, that's not going to be good enough because of the rising debt load. And I'm going to tell you what the government's going to do. They've become clever. They've wisened up. So you see these Treasury bonds that mature in longer than 10 years. They represent a smaller portion of the debt load. When they manufacture a crisis and the Fed drops interest rates to 0% again, they're going to lock in those low interest rates for the long term by issuing more 20 and 30-year Treasury bonds than they normally do. If you don't believe me, I have proof. They've already been doing this. So this is the average maturity of US Treasury securities. After the crisis of 2008, look at what they did. They locked in those lower interest rates by issuing more longer duration treasuries. So look at this. After the most recent crisis, they locked in those lower interest rates with longer term debt again. And look here. Oh, what do you know? When interest rates got higher, they didn't want to lock in those higher rates for the long run. So the average maturity started to drop. So listen, I told you they've wisened up. They know what they're doing. In the next crisis with lower interest rates, I wouldn't be surprised if the government suspends the debt ceiling, borrows a ridiculous amount of money, and even issue 50-year bonds. So listen, when this happens, US Treasuries will fall even further as a reserve asset. So who's going to do all the buying? In other words, who's going to be lending all this money to the US government? It's going to be the Federal Reserve. And it's going to be the Federal Reserve. They're going to get that money by printing it out of thin air. And of course, that is going to be highly inflationary. So I want to tell you this. Over the past few years, we have been going through a melt up. I mean, look at the cost of housing. Look at the stock market. Look at the price of gold and silver. I mean, you see it with healthcare prices. You see it when you buy groceries. So this is a melt up, but we are in the making of the great melt up. And all of this is going to lead to hyperinflation and ultimately a reset, the great reset. Now, in terms of what the manufacturer crisis will be, I mean, your guess is just as good as mine. It could be war. It could be a black swan event. I mean, you let me know. They have a lame excuse to lower interest rates right now. They're going to come up with a lame excuse to lower interest rates back down to zero. They just have to sell it to the public, but I'm not going to be buying the garbage that they're going to be peddling. So this has been episode 3 of the Great Melt-Up series. Next, I'm going to discuss how to capitalize and best position yourself in this situation, in the Great Melt-Up. Please subscribe. I thank you for the support and wish you a very nice day. Take care.